In 2024, Berkshire Hathaway's insurance operations were sitting on roughly $171 billion in what's called float. That's not profit. That's not premiums they've earned yet. It's money that policyholders paid in, that the company hasn't had to pay back out in claims, and that Warren Buffett has spent decades quietly investing to build one of the largest fortunes in history. Most people think insurance companies make their money one way. They collect your premium, and they try really hard not to pay you when something goes wrong. That's the popular image. Deny the claim, keep the cash, repeat. It's the plot of half the courtroom dramas on television. And it's not exactly wrong, but it's such a small piece of the picture that it misses almost everything interesting about how this industry actually works. Quick note before we get into it. This is not financial advice, just an explanation of how the business model works. There are really 3 separate profit engines running inside a typical insurance company, and they work completely differently from each other. Understanding all 3 changes the way you look at every insurance ad you've ever seen. Engine number 1, underwriting profit. This is the part everybody assumes is the whole business. A company collects premiums from a large pool of people, pays out claims to the smaller number who actually need it, and keeps the difference. Simple enough. The tricky part is pricing it correctly, and that's where actuaries come in. These are the people whose entire job is calculating, with startling precision, the odds that your house burns down, your car gets totaled, or you develop a specific illness by a certain age. Get that math right across millions of customers, and the profit takes care of itself. Insurers track something called a combined ratio to see how they're doing. It's the percentage of every premium dollar that gets eaten up by claims and expenses. Anything under 100% means the company made an underwriting profit. GEICO, for example, ran a combined ratio of about 81.5% in 2024, meaning for every dollar of premium it collected, only around 82 cents went out the door in claims and costs. The rest, before other expenses, was underwriting profit. But here's the twist almost nobody talks about. For a lot of the insurance industry, underwriting profit is treated as a bonus, not the main event. Some insurers happily run their underwriting near break-even, or even at a slight loss, because the real money is made somewhere else entirely. Engine number 2, the float. This is the part that turns insurance from a decent business into a wealth-building machine. When you pay your car insurance premium in January, the company doesn't need that cash sitting ready in case you crash in February. Most policyholders never file a claim at all in a given year, and even when they do, there's often a long gap between collecting the premium and paying out the loss. During that gap, the insurer gets to invest the money. Multiply that across millions of policyholders paying in every month, and you get an enormous, constantly replenishing pool of investable cash. That pool is the float. Berkshire Hathaway's float has grown from around $129 billion in 2019 to roughly $171 billion by the end of 2024. It's not Berkshire's money, technically. It belongs to policyholders, in the sense that claims will eventually be paid from it. But until that day comes, Berkshire gets to invest it in stocks, bonds, and entire businesses, and keep whatever it earns. Buffett has described this as being paid to hold other people's money, because when an insurer runs an underwriting profit on top of investing the float effectively costs nothing. Over the past 2 decades, Berkshire's insurance operations generated about $32 billion in underwriting profit alone, on top of everything the float itself earned when invested. That's the difference between a company that merely survives on premiums and one that compounds wealth for decades using money it never actually owned. This is also why insurers care so much about interest rates. When rates rise, the same float, sitting in bonds and short-term instruments, suddenly earns more without the company doing anything different at all. In 2024, insurance investment income across Berkshire's businesses jumped from about $9.6 billion to $13.7 billion, largely because the underlying rate environment shifted in the company's favor. Engine number 3, reinsurance. Here's a piece of the puzzle most customers never think about. Insurance companies buy insurance too. It's called reinsurance, and it works exactly the way it sounds. A reinsurer agrees to cover part of an insurer's losses in exchange for a slice of the premium. If a hurricane wipes out a coastal region, and one insurer suddenly owes billions in claims, reinsurance is what keeps that company from collapsing overnight. This matters for 2 reasons. First, it lets smaller and mid-sized insurers write much bigger policies than their own capital would normally allow, because they're offloading a chunk of the risk. Second, some of the largest financial companies on Earth operate primarily as reinsurers, essentially insuring other insurance companies and collecting premiums for taking on risk that's already been priced, pooled, and diversified once already. It's a layer of the industry that's almost invisible to regular consumers, but moves staggering amounts of capital. Losses from events like Hurricanes Helene and Milton in 2024 ran into the billions, and reinsurance is precisely the mechanism that spread that impact across the industry, instead of bankrupting a handful of individual insurers. Now here's where it gets genuinely interesting, and where the popular narrative falls apart. If claim denial were really the core strategy, you'd expect the most profitable insurers to be the stingiest ones. But the companies that dominate this industry over the long run tend to be the ones with disciplined underwriting and enormous investable float, not the ones fighting hardest to avoid paying legitimate claims. Buffett has said outright that Berkshire's insurers maintain exceptionally strong capital positions, specifically because it lets them write more business and hold more float. Being seen as reliable is part of the business model, not a weakness in it. Let's make this concrete, because these numbers get abstract fast. Imagine an insurer collects $10 billion in premiums in a year and pays out $8.5 billion in claims and expenses. That's $1.5 billion in underwriting profit, a healthy combined ratio of 85%. Now imagine that same company was holding an average float of $30 billion across the year and earned a modest 5% return investing it. That's another $1.5 billion, purely from parking money that technically belongs to someone else. Suddenly, the underwriting business and the investment business are contributing roughly equally to the bottom line, and the underwriting business was arguably the harder one to get right. This is also why insurance is one of the most durable business models in finance. Nobody wakes up one day and decides to stop insuring their home, their car, or their health. Premiums flow in like clockwork, month after month, year after year, largely independent of what the stock market is doing on any given day. That steady recurring cash flow is exactly what lets an insurer invest with patience instead of panic. When a bank or a hedge fund needs to sell assets to meet a sudden obligation, it often has to sell at a bad time. An insurer with a well-run float rarely faces that pressure, because new premiums are constantly arriving to smooth things over. Put the 3 engines together. Disciplined underwriting that keeps the core business profitable on its own, a growing float that gets invested for years or even decades before it's needed, and reinsurance that spreads catastrophic risk across the whole industry instead of concentrating it in one company. None of that requires denying your claim. It requires pricing risk accurately, investing patiently, and staying boring and reliable for a very long time. That's a much less dramatic story than the one in the movies, but it's the one that actually explains why some insurance companies have quietly become among the most valuable businesses on the planet. If this changed how you think about that insurance bill you pay every month, that's exactly the kind of thing this channel is here for. Drop a comment with a question you'd want explained next, hit like if you found this useful, and subscribe if you want more of these breakdowns of how the financial world actually works behind the scenes. Thanks for watching, and I'll see you in the next one.